Hello friends, we'll be discussing certain details about a new chapter that is basic accounting ratio, and the topic that we'll be covering right now is the ratio and ratio analysis meaning and definition. So basically, what do we mean by ratio and ratio analysis? So these are two separate terms but are interlinked together. The ratio being one of the numerical method based on the comparison or on the data that is available or made available to any analyst. Now, any analyst will be comparing the situation of the financial standing as compared to the previous one or as compared to the previous few years. Now, this is depending on the ratio that is made available to him. Now, how this ratio derives is something very interesting. This depends on the kind of numerical values that we have dealt with in the previous financial year or based on the previous financial years. Now, any previous financial year that you take, the data that will be there, it will have certain numerical values in it. This numerical value will be used to consider the ratios or different kind of accounting ratios that we have to study in our near future videos. But right now, what we have to understand is the definition of it. So I'll be jotting this definition down and you can go ahead and understand how the ratio and ratio analysis happens here. So the first part that we'll be understanding is what do you mean by ratio? Now it's a mathematical value and it's a relationship, or rather we can call it as a mathematical relationship between interrelatable variables. To give you a brief description of this, we understand the financial statements that we have the balance sheet, we have the liabilities, assets, we have the profit, non-operating profit, any other thing that is related to accounting statements. Now let's take an example of balance sheet itself. We understand that our liability should be one and our asset should be twice of our liabilities. Now this itself can be called as a ratio. That means the ratio between liabilities and assets is 1 is to 2. For every one liability, you need to have two assets with you. That means if you have a liability of 10 lakh rupees, you need to make sure that you have assets worth rupees 20 lakhs and more. So that is the kind of ratio. Now this is interrelatable. How is it interrelatable? The liabilities and assets both are a part of one financial statements. Interrelatable, hence it is called as an interrelatable mathematical expression, or it's a variable equivalent. Now when we talk about variables, variables are because you can compare between a financial statement, not just the profit and loss items, and you can compare the balance sheet items as well. So when you compare balance sheet items with each other, it refers to variables. When it compare profit and loss items with each other, they can be called as variables. Hence it is a mathematical equation or an expression. Now there's one more line that we have mentioned here. Let's understand that. Now, it's a process of determining, interpreting, and presenting numerical relationship or values in the form of financial statements, or rather, right from the financial statements, you can pick up certain items and then you can compare them with the form of interpreting, determining, and then presenting them. So you have to determine what ratio you're determining, or rather what ratio you're talking about. You have to interpret that ratio according to that, and then you have to go ahead and present it in a form of a financial statement. Like any item that has been picked from the financial statement, it can be from profit and loss account, it can be from balance sheet, it can be from trading account, it can be any other income statement that you have. According to that, you have to pick up certain items, compare them, interpret them, and then present them in numerical value. Now this is the brief description of what ratio means. Now going on to the next part, we'll understand what ratio analysis means. So the first line that we have mentioned here states that it is the process of determining meaningful relations. Now, how this meaningful relations are determined is from the process of calculated ratios. The ratios that we have calculated earlier, on the basis of that you have to determine certain relations and you have to take decisions based on them. Now, whenever you calculate ratios according to this, you understand that, let's take for an example. If you're weighing the height and weight, can you determine or can you say that these ratios have something in common? Height can be compared with weight? Of course not. You cannot compare height of one person with the weight of same person itself. However, you can compare height of one person with the height of another person. Now that's give you, or rather that gives you a perfect or a common parameter to judge two people. Similar way, ratio is something that gives you a common parameter to judge two variables, like the profit and the sale can be compared together. The higher the sale, the higher the profit increases. The lower the sale, the lower the profit goes. This kind of ratio analysis is done using these variables, or rather using these kind of ratio analysis techniques. Now let's hop to the next point of it. Now, ratio analysis basically is the study of various relationship between those common factors. Now, what are those common factors? Those common factors are financial factors. Why? Is because we are studying accounting ratios. Now, accounting is everything and including financials itself. So, numericals, financials, mathematical ratios are all part of financial statement, and the study of this is called as ratio analysis. Now, there are certain pointers that we would like to explain you. So, let's go on to the next sheet, jot them down, and let's understand what exactly it means. Now, there are certain pointers mentioned here. Let's read it out. It's a systematic usage. That means ratio analysis is a systematic usage of ratios to evaluate the performance of the financial statements. Now, whatever items you pick up from financial statements, it's a systematic evaluation or a systematic usage of those ratios to understand the performance of where the company stands as compared to the previous year, as compared to any other company, as compared to the trend of the market according to that. Ratio analysis can be performed on historical data as well as prospective. Now, prospective means any kind of future data that we are expecting or any kind of future expectations that we have. So, on that data as well, that means target basis or performance basis, which is the past one. No, on the data or any data that is related to ratio analysis can be based on either of these two things, historical or prospective financial information. Now, it is not restricted to comparing data from only one statement. That means balance sheet statement data can be compared with income and statement, or income statement data can be compared with cash flow data. There is no such restriction between them. Now, whatever ratios you have, they can be compared with previous year ratios as well. Whatever ratios you have, they can be compared with other entities. That means one company's ratio can be compared with other company's ratio as well, provided they are dealing in the same kind of product. For example, automobile sector, we have different companies who deal in cars. Now, the sales percentage can be compared of one company with the other, like Maruti Suzuki sales percentage can be compared with Hyundai or Volkswagen or any kind of any other company that we have in a market. Hence, it can be compared with any other entity, any previous financial year. That means Maruti Suzuki can go ahead and compare its current sales with the previous sales. Now it is basically expressed in four forms. First one is pure. The example that has been mentioned down here is exactly the kind of form that it is, like 2 is to 1, 1 is to 2. Liabilities is 1, 2 is assets. That is the pure kind of ratio. This is the original kind of ratio that we deal with. Second kind is percentage, like 10% is the sale for current year, 5% was for previous year, 10% 5% comparison is kind of percentage ratio. Times is the third type. Now, the sales have increased 3 times as compared to the previous year. This comparison is known as times comparison of ratio. Fraction is something that we can compare when it comes to partnership accounts. If you remember, we had done partnership accounts earlier, and according to that, in this specific chapter, 4/5 of the ratio or 4/5 of the part has been taken by this. 1/5 was earlier ratio. So we can discuss like this itself. 1/5 was the profit part that we earned earlier. 4/5 is the profit part that we're earning right now. So this comparison, 1/5 is to 4/5, is the fraction ratio comparison that can be done. So this is the brief description that we can have about ratio or ratio analysis. To describe more further, when we go ahead with the chapter, we'll be understanding a lot of different other ratios that can be used for your interpretation. And trust me, this is a very easy and simple chapter and very interesting when it comes to understanding the ratio, how they are derived, where it can be applied. So let's head for it and understand how exactly we can have in the next few videos. Thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.